Question 1. Given the circumstances, Michelle, a commercial property owner in Richmond, Virginia, entered into a lease agreement with a tenant who would operate a bakery. The tenant, Henry, invested $85,000 in equipment and renovations. 6 months later, the property caught fire due to a faulty wiring system in the building's wall. Both Michelle and Henry filed claims with their respective insurers, each asserting insurable interest in the property. Insurable interest, and why? A. Only Michelle, because she owns the property and holds legal title. B. Both Michelle and Henry, because each stands to suffer financial loss from the damage. C. Only Henry, since he made improvements and owns the business inside the property. D. Neither party, since commercial leaseholds are not considered under Virginia's insurance laws. Answer. Correct answer. B. Both Michelle and Henry, because each stands to suffer financial loss from the damage. Explanation. Insurable interest exists when a party would suffer financial loss if the insured property is damaged. Under Virginia law and the general principle of indemnity, both the property owner and a tenant who has invested in the premises through equipment or leasehold improvements have valid insurable interests. Virginia Code SS 38.2 303 recognizes multiple insurable interests in property. Michelle owns the building and Henry has financial stake in improvements and business continuity. Both can insure their respective interests. This avoids unjust enrichment by ensuring only actual losses are compensated. Question 2. To what extent does coverage of a CGL policy respond when a company is sued for negligence due to injuries suffered by a customer who slipped in a lobby? A. It covers only legal defense costs but not the actual damages awarded. B. It covers bodily injury claims and legal defense costs subject to policy limits. C. It excludes slip and fall incidents as they are considered intentional. D. It covers all losses without any limitation, including punitive damages. Answer. Correct answer. B. It covers bodily injury claims and legal defense costs subject to policy limits. Explanation. CGL coverage addresses bodily injury and property damage claims resulting from the insured's negligence. Slip and fall injuries are a classic example of third-party claims covered under this section. It includes both legal defense and damages awarded, but only up to the per occurrence and aggregate limits outlined in the policy. CGL for CG01 governs these terms. Punitive damages, however, may not be covered depending on the policy language and state law interpretations in Virginia. Question 3. Demonstrated by Ista Delgado, a commercial developer who started construction on a multi-unit office complex in Fairfax, Virginia. His insurer issued a builder's risk policy effective July 1. On July 10, framing materials worth $150,000 were delivered to the site but remained in the parking area. On July 12, vandals damaged the materials. Ista Delgado files a claim. How should the insurer respond? A. Deny the claim because the materials were not yet installed. B. Approve the claim since coverage includes materials intended for permanent installation. C. Deny the claim unless a separate inland marine policy was in place. D. Approve the claim only if the vandals are identified and prosecuted. Answer. Correct answer. B. Approve the claim since coverage includes materials intended for permanent installation. Explanation. Builders' risk policies cover buildings under construction and materials intended to become a permanent part of the structure. Per ISO Form CP020, such materials are covered while on site in transit or temporarily stored off-site if the policy is properly endorsed. Virginia law does not require installation coverage to attach provided the materials were designated for that particular job. The policy must clearly include such items in the property description and declarations. Question 4. The most significant aspect of the law of large numbers in the context of commercial insurance is A. It allows insurers to predict individual policyholder behavior with accuracy. B. It minimizes claim frequency by diversifying insured portfolios. C. It enables insurers to predict losses across a broad population and set accurate premiums. D. It mandates equal premiums for all policyholders regardless of risk. Answer. Correct answer. C. It enables insurers to predict losses across a broad population and set accurate premiums. The explanation. The law of large numbers is a statistical principle used in insurance underwriting and rate setting. It states that as the number of exposure units increases, actual losses will more closely reflect the expected probability. Insurers use this to determine premium adequacy and reduce risk volatility. This principle is foundational to commercial insurance and is implicitly embedded in rate filing requirements under Virginia Law SS 38.2-1904. It doesn't allow insurers to predict individual outcomes, but helps stabilize losses across groups. Question 5. When presented with a liability loss scenario, Samantha, the CFO, a consulting firm in Roanoke, is evaluating whether to switch from an occurrence to a claims-made policy for her firm's professional liability insurance. Her concern is about coverage for past services rendered. What should Samantha be most cautious about? A. The claims-made policy offers more comprehensive past coverage. B. Claims-made policies only apply to incidents occurring after the policy expires. C. Claims-made coverage requires retroactive date to protect past activities. D. Occurrence policies do not cover current claims from past events. Answer. Correct answer. C. Claims-made coverage requires a retroactive date to protect past activities. Explanation. Claims-made policies trigger coverage when the claim is made during the policy period, not when the event occurred. Without a retroactive date, claims from services rendered prior to the inception date may not be covered. This is especially important for professional liability policies like EO. In Virginia, agents must explain these new under regulatory expectations of fair dealing. SS 38.2-1800 et seq. Occurrence policies, by contrast, cover events that happen during the policy period, regardless of when claims are made. Question 6. The development of producer licensing in Virginia ensures ethical and professional behavior. A licensed producer is approached by a client with a high-risk manufacturing business. To close the deal quickly, the producer omits the full extent of hazardous material exposure in the application. What regulation has the producer violated? A. The Terrorism Risk Insurance Act, TRIA. B. Virginia's Unfair Trade Practices Laws for Misrepresentation. C. The Gramm-Leach-Bliley Act's confidentiality standards. D. The Federal Trade Commission's Consumer Disclosure Act. Answer. Correct answer. B. Virginia's Unfair Trade Practices Laws for Misrepresentation. Explanation. Virginia Code SS 38.2502 prohibits misrepresentation or omission of material facts in the insurance application process. The producer's behavior constitutes fraudulent act which may result in license suspension, fines, or criminal penalties. Even if the intent was to expedite coverage, altering or omitting risk information undermines the underwriting process. This is distinct from TRIA, which addresses terrorism-related coverage, and Gramm-Leach-Bliley, which concerns client data privacy. Question 7. Among the various coverage options under crime insurance, a retail business adds employee dishonesty coverage after discovering cash shortages. 2 months later, they uncover that an employee has been embezzling funds for over a year. Is the loss covered? A. Yes, as long as the dishonesty was discovered after the policy began. B. No, because prior acts are excluded unless the retroactive clause is added. C. Yes, but only if the employee is convicted. D. No, since crime insurance only covers physical theft, not embezzlement. Answer. Correct answer. B. No, because prior acts are excluded unless a retroactive clause is added. Explanation. Standard employee dishonesty coverage under commercial crime forms, ISO Form CR 021, excludes losses discovered to have occurred prior to the inception of the policy unless a retroactive date or prior loss discovery endorsement is in place. Coverage is not contingent on criminal conviction but on discovery and proof. Dishonest acts. Virginia's commercial insurance framework permits such limitations as long as they are clearly disclosed in policy forms SS 38.2-2100 et seq. Question 8. By evaluating underwriting data, insurers attempt to minimize adverse selection in commercial policies. Which scenario best exemplifies adverse selection? A. A business voluntarily increases its deductible to save premium. B. A high-risk business intentionally delays disclosing prior claims. C. A low-risk company chooses not to renew its policy. D. An insurer adds an endorsement to broaden coverage. Answer. Correct answer. B. B. A high-risk business intentionally delays disclosing prior claims. Explanation: adverse selection occurs when higher-risk applicants seek coverage without fully disclosing their risk, disproportionately affecting the insurer's loss ratios. In B, the business conceals prior claims, skewing underwriting assumptions. Virginia's insurance laws empower insurers to deny or cancel policies based on material misrepresentation, code SS 38.2504. Avoiding adverse selection is critical to maintain actuarial soundness. Question 9. With the advent of high-tech automation, a printing company purchases equipment breakdown coverage. Shortly after, a voltage surge destroys their digital press, halting production. Under the equipment breakdown policy, what is most likely covered? A. Only damages resulting from fire or explosion. B. Sudden and accidental breakdown of covered equipment. C. Only mechanical damage from human error. D. Gradual wear and tear over time. Answer. Correct answer: B. Sudden and accidental breakdown of covered equipment. Explanation: equipment breakdown coverage, formerly boiler and machinery, insures against sudden and accidental damage from electrical or mechanical failure. Coverage includes costs to repair or replace the equipment and may also cover business interruption. It does not cover wear and tear or gradual deterioration. ISO Form BM020 is the standard reference. In Virginia, insurers must clearly define accidental breakdown per filing requirements SS 38.2316. Question 10. Focusing specifically on a commercial insured who states in their application that the premises has a centrally monitored sprinkler system, which is later found to be inactive during a loss event. How might this affect claim settlement? A. The claim is always denied regardless of intent. B. The claim is valid if the insured later fixes the system. C. The insurer may deny or reduce payment due to material misrepresentation. D. The claim must be paid since coverage is unconditional. Answer. Correct answer: C. The insurer may deny or reduce payment due to material misrepresentation. Explanation: in insurance, a material misrepresentation, even if unintentional, can void or reduce coverage. If sprinkler system is presented as functional and it's not, this affects underwriting and premium decisions. Under Virginia law, code SS 38.2309, concealment or misrepresentation of material facts can void the policy. Representations are statements made by the applicant. When they become warranties by inclusion in the policy, their breach has contractual consequences. Question 11. The underlying principle of insurance relies heavily on utmost good faith. Marcus, the owner of a trucking company, knowingly failed to disclose 2 prior cargo thefts when applying for a commercial inland marine policy. After securing coverage, another theft occurred and he submitted a claim. How should the insurer respond under the principle of utmost good faith? A. Pay the claim in full and later adjust premiums. B. Deny the claim due to breach of good faith through material concealment. C. Pay only a percentage of the loss equal to the premiums paid. D. Accept the claim if the prior thefts are unrelated. Answer. Correct answer: B. Deny the claim due to breach of good faith through material concealment. Explanation: the doctrine of utmost good faith requires both insurer and insured to act honestly and disclose all relevant information during underwriting. Marcus's omission constitutes material concealment, which gives the insurer grounds for denial. Under Virginia Code SS 38.2309, failure to disclose material facts, especially with intent to deceive, can void policy. Good faith is cornerstone of contractual fairness in insurance. Question 12. To better understand GarageKeeper's coverage, consider that Tanya owns an auto body shop and offers overnight vehicle storage. A fire originating in her office spreads and damages 3 customer vehicles parked inside. Which coverage would respond to customer vehicle damages? A. Business auto policy. Physical damage section. B. General liability. Premises liability coverage. C. GarageKeeper's coverage under the garage policy. D. Commercial property insurance. Business personal property. Answer. Correct answer: C. GarageKeeper's coverage under the garage policy. Explanation: GarageKeeper's coverage protects a business for damage to customers' autos left in their care, custody, or control. This form of Bailey coverage is part of the Garrett policy ISO Form 05. Tanya's BAP or property policy would not apply here because the autos are not her property. Virginia regulators expect that producers explain these distinctions under Marketing Conduct Rules SS 38.2502. Question 13. Through the lens of the indemnity principle, an insured cannot collect more than the actual financial loss. Xavier insures his warehouse for $1 million under a commercial property policy, but a fire causes $250,000 in damage. He submits a claim for the full $1 million, citing loss of future income. How should the insurer respond? A. Pay the full $1 million as insured value governs all claims. B. Deny the entire claim since intent to profit is against public policy. C. Pay only $250,000 based on actual loss per indemnity rules. D. Pay an adjusted claim for $500,000 based on building valuation. Answer. Correct answer. C. Pay only $250,000 based on actual loss per indemnity rules. Explanation. The principle of indemnity ensures that insurance compensates only for actual losses. It prevents the insured from profiting, aligning with Virginia Code SS 38.22112, which allows insurers to pay no more than the value of the insured's interest at time of loss. Future income is generally covered business interruption coverage, not basic property insurance, unless explicitly added via endorsement. Question 14. In light of recent developments, Clara, a florist operating a small business in a leased retail unit, suffers a water pipe burst that damages her inventory and causes income loss during repairs. Which coverage under ABOP would address both direct and indirect losses? A. Building and personal property only. B. Liability coverage for water damage. C. Business income and extra expense. D. Tenant's legal liability. Answer. Correct answer. C. Business income and extra expense. Explanation. The business owner's policy BOP automatically includes business income and extra expense coverage, covering loss of income due to a direct physical loss. Clara's damaged inventory would fall under business personal property, and lost income during repairs is covered under business interruption provisions. The standard ISO bar BP03 ensures continuity for small businesses. Virginia regulations ensure these forms meet minimum protections under SS 38.22220. Question 15. Upon closer examination, a policyholder finds a clause in their commercial property policy that excludes coverage for earthquake damage. Where in the insurance policy is this clause most likely located? A. Insuring agreement. B. Declarations page. C. Conditions section. D. Exclusions section. Answer. Correct answer. D. Exclusions section. Explanation. Policy structure typically follows this order: declarations, insuring agreement, conditions, exclusions, and endorsements. Exclusions detail what perils are not covered, such as earthquakes or war, unless specifically endorsed back in. According to standard ISO policy structures, this helps reduce ambiguity. Virginia mandates clear identification of exclusions per SS 38.216. C. To ensure informed consent by policyholders. Question 16. While examining his commercial property policy, Harold notes a coinsurance clause requiring him to insure at least 80% of replacement cost. His building is worth $1 million, but he carries only $600,000 in coverage. A fire causes $400,000 in damage. What will he receive after applying the coinsurance penalty? A. $400,000. B. $300,000. C. $480,000. D. $600,000. Answer. Correct answer. B. $300,000. Explanation. Coinsurance formula is insurance carried, insurance required, X loss equals payment text, insurance carried, insurance required, times text loss equals text payment, insurance carried, insurance required, X loss equals payment. Harold carried $600,000 but needed $800,000, 80% of $1 million, $600,000, 1000x equals 0.75x equals 300,000, 600,000, 800,000 x 400,000 equals 0.75x 400,000 equals 300,000, 600,000, 800,000 x equals 0.75x equals 300,000. Coinsurance encourages proper coverage and penalizes underinsurance. Standard on a CP 010 form. Question 17. Contrary to popular belief, a business owner, Elsa, was reimbursed by her insurer after a fire caused by her neighbor's negligence. Her insurer then filed suit against the neighbor. What is this legal action called? A. Arbitration. B. Indemnity recovery. C. Subrogation. D. Tort waiver. Answer. Correct answer. C. Subrogation. Explanation. Subrogation allows an insurer to step into the shoes of the insured after claim payment and recover from third-party tortfeasors. This prevents double recovery and holds negligent parties accountable. Subrogation rights are defined in standard policies and recognized in Virginia Code SS 38.2.207. Waivers of subrogation must be explicit and are often used in contract agreements to avoid litigation between insured parties. Question 18. The impact of terrorism on insurance prompted the U.S. Congress to enact TRIA in 2002. A Virginia manufacturer has a commercial property policy but declines to purchase TRIA coverage. Months later, a certified terrorist attack causes total destruction of the facility. What will be the outcome for the business owner? A. The business is fully compensated under ORIS coverage. B. The claim is denied unless TRIA endorsement was accepted. C. The federal government pays 100% of certified losses. D. The state compensates through a residual market pool. Answer. Correct answer. B. The claim is denied unless TRIA endorsement was accepted. Explanation. TRIA allows insurers to offer terrorism coverage, but policyholders must opt in and pay an additional premium. Without acceptance of the TRIA offer, certified terrorism acts are excluded under most commercial policies. TRIA is codified under 15 U.S.C. SS 6701 and Virginia insurers are required to offer but not mandate terrorism coverage. The law applies to certified acts as declared by the U.S. Treasury. Question 19. Across different scenarios, a real estate broker in Virginia is sued for failing to disclose water damage history to a buyer. The buyer seeks damages for mold remediation. Which policy would provide coverage? A. Commercial general liability. B. Business owner's policy. C. Professional liability (EO). D. Homeowner's liability. Answer. Correct answer. C. Professional liability (EO). Explanation. As an omissions, EO coverage addresses claims from professional services errors, including negligence or failure to advise properly. CGL excludes such claims under its professional services exclusion. Virginia Licensing Statutes SS 38.21800 etc. Emphasize EO as essential for professionals like real estate brokers, insurance agents, and consultants. The coverage is often claims-made, not occurrence-based. Question 20. During the process of selling a commercial property claim, there is a dispute between the insurer and the insured over the value of the damaged equipment. The policy includes an appraisal clause. What is the next best step for resolving the valuation dispute? A. File a lawsuit immediately. B. Wait for arbitration under state law. C. Each party selects an appraiser and an umpire is agreed upon. D. The insurer's adjuster makes the final decision. Answer. Correct answer. C. Each party selects an appraiser and an umpire is agreed upon. Explanation. The appraisal clause allows for an independent dispute resolution mechanism over the amount of loss, not coverage issues. Standard in ASO CP 010 and mandated by Virginia Code SS 38.2.211A. This clause outlines that both parties select appraisers who then jointly agree on an umpire. If the appraisers cannot, the umpire decides. It prevents lengthy litigation and protects policyholder rights. Question 21. By comparing different types of commercial liability policies, Natasha, the CFO, a growing tech company in Norfolk, wants to protect the company's board from potential shareholder lawsuits related to alleged mismanagement and poor financial oversight. Which coverage is most appropriate for this exposure? A. Commercial general liability. B. Errors and omissions insurance. C. Directors and officers DO liability insurance. D. Business owners policy BOP. Answer. Correct answer. C. Directors and officers, DO liability insurance. Explanation. DO insurance provides liability coverage to directors and officers for claims made against them while serving in their official capacities. It includes defense and settlement costs from claims alleging breach of fiduciary duty, misrepresentation, or mismanagement. CGL and BOT do not cover managerial decisions. In Virginia, DO policies are not standard and may include Side A, B, and C protections, which must be evaluated carefully. Regulation follows SS 38.2/2010, requiring honest disclosures in underwriting. Question 22. Taking into account the rising number of employee complaints, a mid-sized manufacturer in Virginia wants to insure against discrimination, harassment, and wrongful termination claims. Which policy provides the most relevant protection? A. Workers' compensation insurance. B. Employment practices liability insurance. C. Fiduciary liability insurance. D. Professional liability insurance. Answer. Correct answer. B. Employment practices liability insurance. Explanation. IP specifically addresses employment-related legal risks, including wrongful termination, discrimination, retaliation, and harassment. These exposures are not covered under general liability or workers' compensation. EVLI coverage is increasingly critical in today's regulatory environment and is typically written on claims-made basis. Virginia employers must comply with state and federal labor laws, and EVLI helps defend against violations even if unfounded. It is separate endorsement or standalone policy. Question 23. For the purpose of managing risks tied to financial transactions, Dennis's law firm in Roanoke adds forgery or alteration coverage to its commercial crime policy. Disgruntled employee alters client's check and attempts to cash it under false pretenses. How does the coverage respond? A. It covers only losses over $100,000. B. It denies the claim unless the bank reimburses first. C. It covers losses due to forgery or alteration of checks, drafts, and promissory notes. D. Applies only to forged business contracts, not checks. Answer. Correct answer. C. It covers losses due to forgery or alteration of checks, drafts, and promissory notes. Explanation. Forgery or alteration coverage under ISO Form CR021 protects against losses from forged or altered financial instruments, including checks and drafts. It is a key part of commercial crime coverage. The insured is covered even if the act was committed by an employee, but recovery may be limited unless the employee was bonded separately. Virginia regulations require these policies to clearly define covered instruments under SS 38.2/2100 et seq. Question 24. While it is true that independent contractors generally aren't covered by workers' compensation, Amanda, roofing contractor, hired day laborer without formal employment documentation. He fell and broke his leg while working on site. What is Amanda's likely liability? A. None, since the worker was not formally employed. B. Full liability under the statutory employer rule. C. Partial liability based on hours worked. D. Liability only for out-of-pocket medical bills. Answer. Correct answer. B. Full liability under the statutory employer rule. Explanation. Virginia follows the statutory employer doctrine under SS 65.2/302, which holds principal contractors liable for injuries to subcontractors or their employees if work is part of the principal's trade, business, or occupation. Since Amanda's roofing business involves such work, she is responsible for providing workers compensation, even if no formal contract exists. Lack of documentation doesn't excuse liability and may increase regulatory scrutiny. Question 25. With respect to data security, William operates an online retail platform and experiences a data breach exposing thousands of customer records. He had purchased a cyber liability policy prior to the breach. What benefit does his policy most likely offer? A. Coverage only for equipment replacement. B. Full payment for physical repairs to his servers. C. Coverage for data breach notification, legal fees, and regulatory fines. D. Reimbursement only for first-party business interruption losses. Answer. Correct answer. C. Coverage for data breach notification, legal fees, and regulatory fines. Explanation. Cyber liability insurance offers protection for both first-party and third-party losses, including data breach response, notification costs, legal defense, and regulatory penalties. It is vital for businesses handling personal data. Standard commercial policies like CGL or BOP do not include this coverage. Virginia. Data protection regulations under the Virginia Consumer Data Protection Act (EPA), reinforcing the need for such policies. Question 26. Examining the consequences of policy selection, Sarah purchases a named peril commercial property policy. Later, her office suffers water damage due to melting snow seeping in through the foundation. Is the damage covered? A. Yes, all losses from natural causes are covered. B. Yes, because water damage is always a named peril. C. No, unless seepage from snow is specifically listed in the policy. D. No, because foundation damage is never covered. Answer. Correct answer. C. No, unless seepage from snow is specifically listed in the policy. Explanation. A named peril policy only covers causes of loss specifically listed in the policy, e.g. fire, lightning, theft. Seepage from melting snow is not commonly listed, so the damage is not covered unless specifically added. In contrast, open peril policies cover all perils except those excluded. Virginia's insurance code supports this distinction. SS 38.2-2100 and policyholders must review declarations and perils covered. Question 27. From multiple perspectives, James, who owns several contracting firms in Virginia, wants to ensure he has extra protection if a lawsuit exceeds the limits of his general liability and auto liability policies. Which policy is most appropriate? A. Commercial general liability. B. Commercial umbrella liability. C. Business owner's policy. D. Professional liability. Answer. Correct answer. B. Commercial umbrella liability. Explanation. Umbrella liability insurance provides excess liability coverage above the limits of underlying policies such as CGL, auto, and employer's liability. It may also offer drop-down coverage where underlying policies exclude certain risks. Virginia recognizes umbrella policies as essential for high-risk businesses under risk management best practices, especially when dealing multi-million-dollar exposures. Question 20. The correlation between tenant operations and liability becomes clear when a business leasing warehouse space causes smoke damage to adjacent units due to equipment malfunction. Which commercial property form best covers this liability? A. Business income coverage form. B. Building and personal property coverage form. C. Legal liability coverage form. D. Inland marine policy. Answer. Correct answer. C. Legal liability coverage form. Explanation. The Legal Liability Coverage Form CP040 provides coverage for damage to property of others that the insured is legally liable for, such as leased property or neighboring units. This is particularly relevant when tenants are held liable for property they do not own. Virginia law recognizes this as a tenant's legal exposure, and lessors often require tenants to such coverage per lease agreements. Question 29. The prevailing attitude toward risk management in service industries like dry cleaning or electronics repair includes insuring customers' property and their care. Which coverage addresses this need? A. Commercial general liability. Premises coverage. B. Commercial property. Contents extension. C. Inland marine. Bailey's customers policy. D. Business auto. Physical damage. Answer. Correct answer. C. Inland marine. Bailey's Customers Policy. Explanation. Bailey's Customers coverage protects businesses that hold the property of others like repair shops or dry cleaners against loss or damage to that property. It is specialized inland marine policy. Coverage extends beyond the insured's own property, something general property or CGL doesn't do. Virginia law allows these policies under inland marine classification, regulated by NAIC guidelines and SS 38.2-1900 et seq. Question 30. The foundation of ethical insurance practice lies in application accuracy. During an audit, regulators find that the commercial lines producer altered client applications after submission to ensure underwriting approval. What is the regulatory consequence in Virginia? A. Policy cancellation with no penalty to the agent. B. No impact unless the insured suffers a loss. C. License suspension, fines, or criminal charges. D. Mandatory retraining without reporting to authorities. Answer. Correct answer: see license suspension, fines, or criminal charges. Explanation: altering an insurance application post-signature is a serious violation under Virginia Code SS 38.21831, constituting fraudulent misrepresentation. The Bureau of Insurance may impose penalties including license suspension or revocation, monetary fines, and even referral for criminal prosecution. The code holds high standards of conduct to protect the public and ensure policy integrity.